Welcome to the Morning Download Podcast, your go-to resource for personal finance, economics, and market insights. In just 8 minutes a day, we provide valuable information to help you make better money decisions.
Hey there, investors. Today we've got something big to talk about: Microsoft versus Google. These two tech giants have been in competition for years, and it's been quite the battle. But who's winning? Well, it depends on how you look at it. Microsoft, with its Windows operating system and Office suite, has long been a dominant force in the tech world. Their products are used by millions of people every day, and they've built up a loyal following over the years. Plus, Microsoft has been expanding into new areas like cloud computing with its Azure platform, which has been a major success. But then there's Google. Known for its search engine and online advertising, Google has become a household name. And let's not forget about Android, their mobile operating system that's used on billions of devices worldwide. Google has also branched out into other areas, like artificial intelligence with Google Assistant and self-driving cars with Waymo. So who's the winner? It's hard to say. Both Microsoft and Google have their strengths and weaknesses, and they're constantly innovating and pushing the boundaries of what's possible in tech. And let's not forget about Apple, Amazon, and other players in the game too. In the end, it's not really about who's better, but rather how these companies are shaping the future of technology. And as investors, that's something we should all keep an eye on. So let's talk about the economy and some recent news. The 10-year Treasury yield has hit its highest level in 16 years, specifically since 2007. Now, if you don't know, this yield is actually an important benchmark for mortgage rates. It's also seen as a barometer for investor confidence. So, what does this mean? Well, experts are saying that it might be time to start preparing for another rate hike. Now, this could have some interesting effects. Some investors may actually choose to leave the market due to uncertainties, rising rates, and increasing debt. It's definitely something to keep an eye on. Now, moving on to some global news. The Russian ruble has fallen under 100 against the dollar. That's quite a drop. And it looks like things may not be getting better for the British pound anytime soon. After recording its worst month in a year, experts are expecting it to fall even further. That's not great news for those who deal with the pound. And finally, let's talk about India. Did you know that the country's elderly population is expected to double by 2050? Not only that, but it will actually overtake the number of children. That's an interesting shift, and it's definitely something to consider when thinking about the future of the country. Let's dive into what's been going on in the crypto world lately. It seems like things have been pretty calm, with not much excitement happening. Prices have been struggling for a while now, and it's clear that the topic of ETFs and the lack of regulations is still making waves in discussions. But hold on, we do have a couple of updates for you. The head of Portugal's central bank has recently called for global regulation in the crypto industry, claiming that it's currently unsustainable. This could potentially have some significant impacts on the way things are done moving forward. And speaking of regulations, it's expected that new crypto regulations will soon follow the introduction of Bitcoin ETFs. So this could be another important development to keep an eye on. In response to the poor market conditions, Analysts, a prominent crypto analysis firm, has unfortunately had to make some workforce cuts. They've had to let go of 15% of their staff due to the ongoing challenges in the market. It's always tough to hear about job cuts, especially in an industry that holds so much potential. To wrap things up, it looks like Bitcoin is back below the $27K mark after some investors decided to take their profits and walk away. This has also led to a downturn in the prices of other cryptocurrencies. So it's definitely been a slightly sluggish period for crypto enthusiasts. Let's see what happens next. Investing in real estate for retirement is a popular strategy that many people consider. Take my neighbor, for example. He bought 2 fourplexes as part of his retirement plan, and so far it's working out well for him. However, it's important to note that he spends every Saturday taking care of those properties. If you're wondering whether real estate could be the right move for your retirement plan, let's explore the benefits and risks together. One of the main advantages of investing in multifamily real estate is the potential for passive income. Rental payments from tenants can generate a steady stream of income, allowing you to build wealth over time. And the average rent for an apartment in the US is around $1,702, but this can vary depending on factors like location and property quality. If you choose your properties wisely, you could easily make a decent amount of money. This rule applies not just in the US, but in most countries. where you can expect to make about 1% of the property's value. Knowing the rental value of your property is crucial for calculating potential earnings. Another advantage is the potential for capital appreciation. Over time, multifamily properties can increase in value, leading to additional profits when you decide to sell. However, it's important to note that appreciation rates can vary greatly depending on the market. In 2022, the annual appreciation for detached properties in the U.S. was around 20.3%, slightly lower for attached properties at 15.2%. However, some states reported lower rates around 4%, while others saw as high as 25%. Tax benefits are another perk of real estate investing. As a real estate investor, you can take advantage of tax deductions for depreciation and energy-efficient upgrades. Explore these benefits to fully enjoy the perks of being a real estate investor. Diversification is also a benefit of investing in real estate. Adding real estate to your investment portfolio can help reduce overall risk by diversifying your assets. This is because the real estate market often moves independently from other investment markets. Additionally, there are economies of scale to consider. When you own multiple units, you can spread out the costs of property management, maintenance, and repairs over a larger number of units. This can lead to cost savings and increased profitability. Of course, like any investment, there are risks involved in real estate. Beyond the time and expenses required for property upkeep, there are other factors to consider. Tenant risk is a concern, as unpaid rent can strain your cash flow and make mortgage payments difficult. Additionally, finding tenants can sometimes be a challenge due to the rental vacancy rate, which currently stands at 6.30% in the U.S. Property damage, is another risk. Tenants may cause damage to your property, resulting in costly repairs. Insurance can help cover some of these expenses, but it's still something to be mindful of. Market risk is also a consideration. The value of your property may fluctuate based on market conditions. If the market takes a downturn, it could be difficult to sell your property or refinance your mortgage. To mitigate this risk, conducting thorough research and potentially working with a real estate agent can be beneficial. In conclusion, investing in multifamily real estate can be a viable strategy for building wealth and generating passive income for retirement. Consider the potential benefits, such as passive income, capital appreciation, tax advantages, diversification, and economies of scale. However, be aware of the risks involved, including tenant risk, property damage, and market fluctuations. By carefully weighing the pros and cons and conducting thorough research, you can determine if real estate investment aligns with your retirement goals. Let's talk personal finance and an interesting quote that caught my attention. So I came across this quote by Jim Chanos from Kinnikos Associates, and it goes like this: Tesla is not just a car company, it is a technology company that is revolutionizing the transportation industry. Now, this got me thinking about Tesla and how it's more than just a car manufacturer. I mean, sure, they make these sleek and futuristic electric vehicles that are turning heads on the streets. But what makes Tesla so fascinating is their innovative approach and their vision for the future. You see, Tesla is not just focused on building cars. They're all about pushing the boundaries of technology. They're constantly coming up with new ideas, like autopilot features, renewable energy solutions, and even exploring the possibilities of space travel with SpaceX. It's truly a testament to their ambition and determination. And it's not just about the products they create. Tesla is revolutionizing the entire transportation industry. They're challenging the status quo, promoting sustainability, and making electric vehicles more accessible to the masses. In a way, they're paving the way for a greener and more efficient future. So when you think about Tesla, don't just picture a car company. Think of it as a beacon of innovation, a technology company that's shaping the way we move and interact with the world around us. That's what makes them so much more than just another car manufacturer. And that's a wrap on this personal finance quote. Pretty thought-provoking stuff, right?
In today's episode, we covered a range of topics, including job openings reaching record highs, the impact of rising treasury yields on investor uncertainty, and the benefits and risks of investing in multifamily real estate. Thanks for tuning in to the Morning Download, your go-to podcast for personal finance, economics, and market insights in just 8 minutes a day. Don't forget to subscribe for more helpful content and sign up for our free newsletter at morningdownload.com/subscribe.